Dom Chu, what you got in today's market navigator, sir?
All right, so Tyler, could bigger gains come from smaller packages? That's what we're going to navigate today. Spotify is actually hanging just below its record highs at this point, and our next guest says the streaming service could ride the coattails of bigger entertainment rival Netflix. Now, Spotify is due to report earnings later on next month on November 12th. So to get ahead of that trade, joining me now is Todd Gordon, the founder of Inside Edge Capital. Todd, let's talk about whether or not Netflix now sets the stage for even more outperformance on a relative basis from the likes of Spotify. They're not direct competitors, but you get the idea.
No, you're right, Dom. They're part of the same sector and industry, not industry group within communications. But Spotify it looks great. As you said, it's hanging below the highs. I've held the stock since I first added it in Feb of last year, added sub-Feb of this year, just added a little bit more. And if we can break above this all-time high, probably after earnings, Dom, I'd like to add to it. So the technical chart, if it's up, you've got the old high from 2021 set to go. And this is in a market that's still kind of hesitating. I mean, the earnings in this company, Dom, are insane. I'm looking over at my notes here. Forgive me, I don't have it memorized. But in 2022, they lost $3.09 a share. 2023, they lost $2.95. This year, they're going to make about $6.50, and next year they're looking for $9, right? So they're generating a ton of free cash flow. Last quarter, they blew away expectations. I think they've won the music streaming war over Apple and Amazon, Pandora, and also TikTok just closed their music streaming service. As I mentioned, Netflix just beat part of the same sector. Their ad-supported tier was very strong, and Spotify is using AI to generate, this ad platform so they can increase revenue there. But also it's just indicative of increased advertising and I think a stronger space. So I like it. Probably looking to add after earnings. And again, this will be my fourth add on Spotify.
So Todd, if that is the case and you're looking to make this catalyst type trade, what exactly is the strategy? You mentioned trying to add after earnings. Does that mean you're expecting a pullback on the heels of those results? Why not add right now? And how exactly would you play it?
Yeah, what a great question, Dom. There's certain stocks in here, namely some large semiconductor, a couple large comms, as already mentioned. You can't be afraid of momentum in this market because the tape collectively is quiet. We have some macro influences that are affecting the indexes, but there's some stocks, some large cap stocks that are just trending, momentum, institutional money is flowing in. You can't be afraid to buy. So if I have to buy it up, Dom, 5%, 8% after earnings, I have a good cost basis. You should be riding stocks that are generating significant profits in this market. Can't be afraid to buy strength. So if it's higher, Dom, will buy it.
How did they turn the corner on profitability?
Really good question. They have really cramped down on their costs. They're generating a lot of free cash flow. They're adding a lot of subscribers. And I think just that momentum as it seems that people are turning away from Apple. Amazon didn't work. Pandora, Sirius, and then the big one is TikTok, Tyler, as they shut down their streaming service out of ByteDance. The efficiencies, the free cash flow generation. I think last quarter, Tyler, they beat free cash flow by 50%. I think they were looking for like $350 million in free cash flow, came in at $550. My numbers are probably off, 20 or 30 million, generating a lot of free cash flow. And, it's a wonderful product.
They're big in music.
We all use it.
Yeah, they're big in music. They're big in podcasts. They're big, they're sort of the dominant name. Kind of the dominant name there, as you mentioned, some of the other competitors that are just don't seem quite as robust as Spotify does. All right, Todd, thank you very much.
So what's interesting about this, Ty, if you look at the reason why Netflix did so well, part of it was that whole ad-supported tier growth. In a stretched consumer environment, which is what many people are talking about right now, and people are making decisions about where to allocate their money, many are trading down, right? They're not going to pay the premium. They're going to go for that ad-supported side of things. So that's going to be a kind of key for a lot of these streaming services, the discretionary income, whether or not people trade down. And
how many you have, how many you carry. Do you carry Spotify and Apple and Amazon Prime? What do you carry, and what can you afford to jettison?
Well, for right now, the consumer is good, but if it gets worse, then those are going to be tough choices.